Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alexandria Real Estate Equities Inc. quarterly report. Alexandria Real Estate Equities, Inc. provides a wide range of businesses and services through its life science REIT platform. The company's offerings include development and ownership of collaborative megacampus ecosystems in top life science innovation cluster, locations operation of Class A/A+ properties, with 39.7 million RSF of operating assets construction and development of new Class A/A+ properties, including a 100% pre-leased committed project strategic capital investment through its venture capital platform for transformative life science companies. Alexandria Real Estate Equities, Inc. ARE, has seen its stock price drop by 26.54% in the past year due to several key factors. The company's lowered financial forecasts and disappointing third-quarter results have contributed significantly to this decline. Additionally, macroeconomic uncertainty, high interest rates, negative net absorption, and softening occupancy rates have all taken a toll on the company's performance. Analyst downgrades and price target reductions have further exacerbated the situation, leading to a substantial negative sentiment among investors. The combination of these factors has resulted in ARE's stock experiencing a significant decline over the past year. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and economic factors. On the one hand, revenue growth is driven by strategic investments in Class A/A+ properties, particularly in AAA locations, which generate higher rental revenues. Additionally, development and redevelopment projects, as well as pre-construction activities, contribute to future revenue streams. On the other hand, revenue decline is primarily attributed to market-related factors, such as reduced demand across the life science industry, increased supply for life science real estate, and lease expirations in key markets. Furthermore, potential dispositions of non-core assets and decreased same-property net operating income also negatively impact revenue. The overall performance of revenue growth or decline will be influenced by a combination of these factors, as well as macroeconomic conditions such as inflationary pressure, recession risk, and changes in foreign exchange rates. Net income and profit margins. A changing landscape, the net income and profit margins of a company have undergone significant changes over the past year. For the 3 months ended September 30, 2025, net income decreased by $118.5 million, 5.8%, compared to the same period in 2024. This decline was largely due to government policy and regulatory disruption, which introduced volatility and uncertainty. Profit margins also saw a decrease from 241.6% to 251.9%. However, excluding dispositions completed after January 1, 2024, profit margins would have increased by 7.3%. The expected increase in profit margins is attributed to the delivery of new projects and stabilization of existing ones. The reasons for these changes are multifaceted. Dispositions of operating properties after January 1, 2024, decrease in occupancy rates, government policy and regulatory disruption, potential declines in adjusted EBITDA, elevated material costs from tariffs and trade conflicts, and reduced tenant demand and financial strain due to increased operational costs, reduced grant support, and drug pricing pressures have all contributed to the decline in net income and profit margins. The future outlook for net income and profit margins remains uncertain. Elevated benchmark interest rates and limited availability of capital are expected to negatively affect profit margins. However, the company is optimistic about its ability to increase profit margins through delivery of new projects and stabilization of existing ones. The company is indeed generating positive operating cash flow, as evident from various financial summaries and references throughout the report. The net cash provided by operating activities has been consistently increasing over the years, with a significant amount of $2.3 billion in 2024. This trend is expected to continue, with projected net cash provided by operating activities reaching $475 million at the midpoint of the company's 2025 guidance range. These figures clearly indicate that the company is generating sufficient operating cash flow to support its business operations and investments. The company's financial summary reveals some changes in its debt level and interest expenses. Notably, the company issued $550 million unsecured senior notes payable in February 2025, but this was offset by the elimination of an outstanding balance on its unsecured senior line of credit. However, commercial paper notes increased to $1.5 billion as of September 30, 2025. More significantly, interest expenses have increased by approximately 7.1% from $114,911 in 2024 to $123,111 in 2025. This increase suggests that the company's debt level or interest expenses have changed significantly, with a notable rise in interest expenses over the past year. The financial summary of our company reveals areas where we have struggled and those that pose potential risks for the future. In terms of performance, the life science industry as a whole has been underwhelming, while early-stage private biotechnology companies have also seen subpar results. Looking ahead, there are concerns about the U.S. life science real estate market and regions affected by high tariffs or trade conflicts. These areas may experience decreased growth or even decline in the future. Management is optimistic about the company's outlook despite facing industry headwinds. The strategy focuses on developing high-quality properties, managing interest rate risk, and forming strategic partnerships to mitigate risks. Key initiatives include deepening relationships with top-tier venture capital firms, expanding proprietary products, and enhancing data analytics capabilities. However, management acknowledges concerns around cash flow uncertainty, volatility in equity investments, and potential impacts on business operations and financial results. Acquisitions and divestitures overview. The company has made several acquisitions and divestitures in recent years. Notable acquisitions include a recently acquired office property in Canada, although specific details on date or amount are not provided. On the divestiture side, the company has completed dispositions aggregating $340.9 million as of September 30, 2025, with an additional $1.2 billion expected to be completed by the end of 2025. Dispositions and sales of partial interests in core and non-core real estate assets have also been made, totaling $1.5 billion. The company has also announced potential dispositions of real estate assets at a future date, and certain dispositions are expected to be completed in the first half of 2026. Additionally, pending transactions subject to non-refundable deposits or purchase and sale agreement negotiations aggregated $1 billion as of September 30, 2025. Overall, the company's acquisitions and divestitures have been significant, with a total value of over $3.2 billion in dispositions completed or expected to be completed by the end of 2026. The company's financial summary reveals a consistent history of paying dividends. From 2013 to 2025, the company has maintained a regular quarterly dividend payment schedule. This indicates that the company prioritizes returning value to its shareholders through dividend payments rather than repurchasing shares. Concerns about inventory buildup and supply chain disruption. The pharmaceutical industry is facing potential disruption due to tariff escalation on products from China. This could lead to supply chain issues, affecting the importation of branded and patented drugs into the U.S. Additionally, growth in China's biotechnology sector may alter demand for U.S. life science real estate. Rising construction costs are also a concern, driven by difficulties in procuring materials at reasonable prices, particularly those subject to tariffs or disrupted supply chains. This is causing project budgets to increase and timelines to extend. Supply chain disruptions are affecting tenants' ability to import and export materials, components, and specialized equipment. That concludes the financial summary for Alexandria Real Estate Equities Inc. Feel free to comment below, and I will be happy to answer them when possible.